Just this past week, a big red light for measuring the macroeconomic picture went off, warning investors of a potential recession in the years ahead, potentially even a stock market crash in the years ahead, because this same indicator went off previously before the great financial crisis, as well as the dot-com bubble, as well as many previous recessions and crashes before. So let's dive into what exactly is this latest news and what does it potentially imply and how our investors are preparing themselves for this. So let's dive right in so that way you can understand. If this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing, a no-hype mission-focused channel trying to find you exceptional companies and unrivaled investments. Here's a disclaimer you can read on your own time. And so first, a little bit of context. Check out David Tepper. He's one of the most successful investors of all time. When he speaks, I listen. He's been a mega bull for the better part of this past decade, and he nailed the cycle turn in 2020. They even called it the Tepper Rally after him because of his confidence and his phenomenal returns. He talked about going balls to the wall in terms of investing and, making huge levered bets that worked out extremely well this past decade. To get context for how much money he's made, one way he celebrated making several billion dollars, I think he crossed the $20 billion mark, was from buying the mansion of his former Goldman Sachs boss who refused to promote him. And he bought this mansion for $43 million and then tore it down to build a mansion 2x larger. So it shows you in terms of the money that you're dealing with here. So what's he saying now? What's David Tepper saying now? He's saying caution. He said there isn't really any really great asset classes now, and he doesn't think stocks are a great investment here, but says it all depends on rates, as in interest rates. Well, first, what are interest rates saying? And second, or I guess first, what should we dive into is he right that there's no great asset classes now? And clearly many crypto speculators don't agree. I mean, crypto as an asset class has been on fire. For example, as Vice published just earlier this past week, I believe, they talked about how one investment in the Shiba Inu meme dog coin of around $8,000 turned into a $5.7 billion investment. Holy smokes. Now, maybe this is just a reflection of the frothy signs of the times. I mean, $8,000 to several billion. But let's go back to Tepper. So what are interest rates saying? And as Scott Minard, who runs the investment firm Guggenheim Partners, called out recently, the 20 and 30-year treasuries have inverted for the first time since 2009. This means that the yield from owning a 20-year bond is higher than owning the 30-year bond. This doesn't make any sense because, normally normal economics would say, wait a second, if I'm going to own this bond for 30 years, I want to get compensated for that extra 10 years. So this means there's a risk aversion behavior where bondholders are saying, hey, there's something else that's going on that's overriding that typical decision-making process. This is a really important indicator that's recognized around the world, folks. An inverted yield curve has historically preceded major recessions and stock market crashes like the dot-com crash and the great financial crisis. It reflects that bondholders are worried about the economy and potentially lower economic growth rates in the future. The challenge is that this signal can lag for months. It's not necessarily like, hey, the stock market crashes tomorrow. It could be, over the next few months, might be even the next year or two. It's probably not an indicator that says, hey, 5 years out. This is more of a next maybe 12 to 24 months type of thing, maybe 28 months. It's not 5 years out, though. Part of this concern of, let's say, slower growth or slowing economic environment is that the U.S. government is running huge deficits and can't run at these huge deficits forever. I mean, we're talking about 10 to 20% deficits, percentage of GDP, and you can't do that forever. And in the next few years, if deficit spending is curtailed, that will be a real headwind to the economy unless, let's say, the private sector picks up the slack. So we will see. I mean, you're talking about a multi-trillion-dollar reversal. And yes, the U.S. government right now is sort of saying, hey, why not slap on another stimmy package or some sort of infrastructure bill? Maybe that holds it over. But then what happens when you reach a point when you sort of wear through that and then you go year over year, you start actually looking at negative figures. So that might be one concern. Another aspect might just be higher rates. And despite two inverted yield curves, which is pretty amazing in and of itself. Usually you get one. So now you have two inverted yield curves where the 2-month yield is higher than the 6-month yield. That might be part of the debt ceiling concerns. But you also have this 20-year that's higher than the 30-year, 2.01 versus 1.98. What I think Tepper is really saying is to follow the Fed. And if the Fed starts tapering and rates start jumping higher, don't be surprised if risk assets start coming under pressure. So look, he's had an incredible track record, multi-billionaire, incredible investor. So worth listening to, and he's been super bullish this whole cycle when a lot of other folks were worried. So here it is. He's the one that's turning well ahead of most folks when, folks are saying, hey, bubblicious times. So this prospect of, risk assets coming under pressure and rates starting to jump higher, that's likely a when, not an if. That said, for now, the market attitude is yields remain low. It's 10 years still around 1.6%. And so party on. I mean, that's what it seems like right now. And he even called that out saying, look, if the 10 year stays around here, he wouldn't be surprised if he traded in and out of this. Maybe the market goes up 10%, if yields stay low. So that's a big question mark that people are focusing on is will bond yields start just, jumping higher on their own? One fund manager that's trying to capitalize on this risk right now and possible move is Bill Ackman. He recently gave a presentation to the Federal Reserve of New York, so the policymakers, so they're listening, encouraging a quicker taper and to begin raising rates ASAP. And he's also talking his book as he's betting that rates will move higher and using it as a hedge against his long-only portfolio. So he does have a macroeconomic hedge saying, look, I recognize my stocks will likely get hit if rates start moving higher, so I do want something that benefits if rates start moving higher. I want this sort of economic hedge. So that's how Bill Ackman's playing it. My personal approach has been to be more cautious in this environment. I, too, consider hedges to protect my portfolio. I also try to find companies that might do well regardless of the environment. For example, I bought a stock that trades at a 30% discount to book value and has a multi-decade history of conservative performance while crushing the indices. So conservative behavior while crushing the indices, the stock market indices. For more detail on that, I call that out exclusively to my Journey subscribers at unraveledinvesting.com. Click Join the Journey if you're interested. And by the way, if you enjoy videos like this, please make a point of hitting that subscribe button, hit that thumbs up button. I also recently called out Facebook stock. This was publicly on YouTube, soon to be Movers, that I own as well. While Meta's advertising business could get impacted by a recession, right now it does seem pretty cheap. High teens earnings multiple for their ad business, which is growing over 30%, maybe 35% plus this year, and doesn't give any credit for their incredible bets on the metaverse. They had some really interesting news today, effectively working on their haptic technology, which really blows me away. I mean, you're going to be able to see a haptic suit, I'd argue, in the probably next 5 years, which would be really neat to layer that on with a VR environment. Anywho, we'll see what happens with Meta stock in the years ahead. And full disclosure, I do own Facebook stock. But if this video, talking about this macroeconomic indicator that just went off this past week, seeing that the credit investors typically lead equity investors. You typically start seeing this move, this nervousness with bond investors before you see it in the stock market. So if this video sort of calling out this risk, how bond investors are starting to say, hey, this is a concern, we're willing to accept a lower yield on 30-year versus the 20-year. If this video has been helpful for you, please make a point of hitting that subscribe button, hit that thumbs up button. Thanks so much for watching.